price will do what it's going to do because it's coded to do it based on time. Okay. And time is essential. It's the first hallmark to when and why a market should produce a displacement, a run, whether it be impulsive, whether it be retracement, whether it be anything. It's always going to be delivered on the basis of time. It's going to move at a specific time or a period of time within 20 minutes. That's a macro. And we're going to talk about those things because I want to simplify it for my son. You all are getting that benefit of seeing it, hearing it, and being explained to you as if it were you being Caleb. I'm not hiding anything. I just sent him a text before I started. I said, just stop texting me. I'm doing it live right now. Don't talk to me in a text because you're going to distract me. Okay. So there's no secret texting going on. There's no conversation behind the scenes. Everything you see and experience while I'm doing these live streams is exactly what he's digesting the same way. So when we look at individual setups like this, you want to sit down in front of the marketplace right before 8:30. Okay. Preferably 8 o'clock. And you want to look at where the highs and the lows are in deference to the 1 minute chart and the 15-minute time frame. So I'm going to change this chart over to 15. So here's what 15-minute looks like here. And if you look at where we came from, see this high at 7 o'clock in the morning? That's this high right there. See it on the right chart? So this chart, this larger chart here is the 1 minute, and this is the 15-minute time frame. 15, 5, 1 minute. Those are your first three time frames to worry about. Okay, and I shouldn't say worry because it's kind of like gives you a subconscious concern that you need to worry about it. You don't need to worry about it. But the levels and inefficiencies on the 15-minute time frame, the 5-minute time frame, and the 1 minute time frame. If you're brand new, you don't know how to trade ICT, you don't know how to trade price action, you don't know how to trade period, okay? You don't need any other time frame. Okay, you don't need anything else. You don't need a daily chart. You don't need an hourly chart. You don't need a 31-minute chart. You don't need a 17-minute chart. You don't need a 15-second chart. You don't need anything below a 1 minute chart. You don't need anything else to do what I'm going to teach you. Okay, this is what you're doing. You're studying price at specific times of the day. If you're not writing this part down, you're blowing it already. So between 8 o'clock and 8:30 in the morning, New York local time or Eastern Standard Time, in the US. Everything I mentioned in terms of time, if it's the time that matches New York local time. So set a clock. If you have your smartphone, there's a way that you can pull up world time and put one in there for New York. And you'll always know what time ICT is saying to look for these things to happen because they're never going to not be there. Write that down again, okay? And underline it. This is always absolutely without fail. It's never not going to do it. It's always every single effing day. It's going to do this very thing. It's going to do it. It's going to absolutely do it because there is an algorithm and it does this to spur on emotional interest or tangible orders that are actually sitting out there. Real orders that are sitting above and below or inside of inefficiencies where the market needs to offer fair value to the marketplace. So what is it reaching for? It's reaching for old highs, old lows, and inefficiencies. That's the fair value gap. SIBI, VISI, that thing. So once we know that the market is likely to do these things, that's a characteristic. It's an algorithmic characteristic. You don't need anything else besides this element as a foundation to what you're trying to trade, and you can make all the money you'd ever want. I'm going to say that again in case you missed it. You're trying to find right now, you want the daily bias and you want to be able to buy below the open and hold for the whole entire day. But are you really doing those things when you try to trade? No. Because as soon as you get 10 handles or 10 pips or whatever, you start struggling with holding on to the trade. You're paranoid that that winning trade that you just found out just fell into your lap. Oh my goodness, I'm winning. This is something new. I need to secure this. But then you're thinking, oh, wait a minute, I'm supposed to be holding for the daily range. And now you're wrestling. And that becomes a real hard wrestling match, doesn't it? So when we're looking at price, as you, as a brand new student, not knowing what to do, you want to make this kind of like a game and a discovery, something fun. Not a video game, okay? But it's a game of determining, does it have what it takes to move to these highs here? A way of saying it to yourself that's very disarming. It's okay. I see how this is smooth. These two highs are relatively equal. That looks like a real nice, obvious flat space in price. We don't see that same flatness down here. You see that? So in other words, if you had a shark, if you had two sharks rather, you have two sharks in front of you. One has had its teeth removed. Well, that would be represented something like this. This is the shark with no teeth. It's basically got gums. Okay, there's no teeth there. Down here, there has been a shark attack. How do we know that? Because we can see the wounds from the teeth, the jaggedness, the jaggedness, the jaggedness, and now it's going to another frenzy or feeding. Where is that? Well, we've just created one. We have this high here that's really close to this one. You see that? So you observe price action and you're looking for areas that look real smooth and safe, where they say peace and safety, sudden destruction comes upon them. Any time that you're looking at price action, and it doesn't matter what time frame you're looking at, okay? If you're looking at it through the lens of a second chart, sub 1 minute, or a weekly chart or a monthly chart or a quarterly chart where it's 3 months of data compressed in to make the candlesticks, it does not matter. This principle is always true. The market will go to an area of smoothness for the purpose of disrupting any orders that would be resting above or below it. So what we're looking for always, the first thing that you're looking for, Caleb, is where is the market smooth on the 15, the 5, and the 1 minute chart. Is that complicated? Nope, it's not complicated at all. It's real simple. What does it look like to be smooth? Well, when you have price levels that create highs, like this swing high here and this swing high here, they're real close to one another. See that? When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? How do you know that, ICT? What differentiates that from any other? Okay, it's this. If you have two swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there. Just like you see here. We have a high, and then the swing here happens to be just a little bit lower than that one. Here's what's going on. This is called priming, okay? Priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors. And they think, oh, it's going to go through that high. But then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left. That frames these two as relatively equal. Okay. Same thing is occurring here. We have this high here, this one being slightly lower than that one. So when the market went up like this and we had this drop down, what that causes is a sympathetic sigh. What is that causing people? Anyone that went short here, they feel like, okay, That's scary because it almost went to that high where their stop loss would be if they're trying to go short in this area. See that? So what do you think it looks like when we have relative equal lows? What would be a high probability relative equal low that the market is likely to draw down and go below? It would be a low that has a slightly higher low. In common terms, it's referred as a failure swing. Okay, so a failure swing. Now a lot of people say, "Oh, see, he's just reinventing." No, see what you're trying to trade that. That's what a failure swing is. When you're trying to trade, long or short on that second pass that doesn't take out the low or take out a previous high. That's selling short a failure swing. Okay. What I'm teaching you is how to identify in price action where the algorithm will refer back to and why. What are the central tenets as to what the algorithm is referring to at a specific time of day, most important. And then it refers back to these because, okay, it sees this high based on time, and then the high prior to that one is here. So it's very simple for the algorithm to call that information as an array and say, okay, this high was at this time, and this high was higher than prior to it, and they're in close proximity. What's the filter? I'm not going to tell you that, but it's not very much in terms of difference between the price. Between 8 o'clock and 8:30 in the morning, you want to sit down and determine where are the smooth locations in price action on the 15-minute, the 5-minute, and the 1-minute. Okay, let me go. We've had the 15-minute on. Let's go down to a 5. Okay, so right away you can see that this high here is relative to that one, and this one here also with that. This one being slightly higher than that one. So there's a lot of liquidity that's sitting at 17,820.75. Now, real important, it does not mean that it has to happen during that session. It does not mean that. And that is the underlying risk that you assume every single time you take a trade. You're looking for things that are going to stack the odds of probability in your favor. It does not mean it's an absolute guaranteed outcome. Well, I'll give you an example right here. We have the relative equal lows here, and the market drops. You see that? So this drop down here, every up close candle on this time frame, all of this right here, that is your breaker. The most sensitive candle or range is going to be the last up close candle. Look at it like this. That's this range low. And see where the body stopped right there? We wick through it, I'm not denying that, but the damage is always done by the wick. And the range high there. Oops, sorry. That is your bullish breaker. But the range here from that up close candle that starts all these consecutive up close candles, all of that is technically the bullish breaker. But the most sensitivity is going to be seen in that last up close candle. That is not supply and demand. That's not supply and demand zone. Sam Seidman would never, ever, ever refer to what I just said. He would never do that. And he would never consider that anyway because we're cutting through candles. Because we're looking at what an algorithm is doing, not some floor trader ticket runner's perception of something that doesn't really exist. So the turn here at the bodies, that tells you what? It tells you the narrative. So what is it going to do? It's going to go higher. Okay, so what at that time would you focus on? Well, you have this short-term high here. The inefficiency that's traded to there. We want to see it trade above it and then act as what? Support, which would be a what? Inversion fair value gap. To do that, what would it reach for next? This high and this inefficiency. Does it do that? Yes. What are the bodies doing? Stopping just at that same level here. And more specifically, and my eyes didn't notice this when I put it up here. You see that little separation? That's a volume imbalance. Go back and listen to the other lectures. You have to include that. volume imbalance when you have fair value gap, whether it be BISI or CIVI. I don't know, put it on there you go. And you can see the bodies being encapsulated by that. And now the market trades back up into that. The bodies candlesticks are trading inside the inefficiency. It wicks above it, but look where the bodies are stopping. And look where the bodies are over here. Where's liquidity at? Below here. Nothing in here. This is all very balanced price delivery because it's back and forth. Every other candle is overlapping the highest high and the lowest low, pretty much kind of like coloring it very, very, very good. Back and forth. All this price action is back and forth versus then we have all these run where we have separations in here, back down into that breaker there. This response right here to what it's just done there, that expectation and response in how price can react to levels like that, that's a nice little scalp right there. I mean, look at it. Moved from 515 to what? 596. That's a good run. You can't get 20 handles out of that on a 15-second chart. You can if you know what you're looking for. Now also notice that we've created again high, lower high, high, lower high, but real close to one another. When did it form? Prior to 9:30. So we have 8 to 8:30, and then you study 9 to 9:30 because it's going to do what? It's going to look and seek the liquidity or inefficiencies. So here's 9:30 right there, forming on the bullish breaker. It trades down, and then we have relative equal highs here. I don't like to usually do this, but I have to do it for the sake of discussion. So we have these relative equal highs, this high and that high, relative equal high, and we have this area up here. So if the market's going to do what? If it's going to make a punishing move towards the shorts that want to see it drop because the market has dropped early on, 7 o'clock in the morning, okay? And we have all these very clean levels. What did we just do here? We have a low. It was traded down into. It disrupted this little area in here. So it's made this area jagged. Remember I was saying earlier where the market's real smooth over here versus what it was doing down here. Where has the work been done? Meaning, if there is a group of traders that are very cannibalistic and they tend to be more correct than wrong, or if they are the ones that generally make the money more consistently than the ones that don't. In other words, think of like the World Series of Poker. Okay, if you ever watched that, it's really fascinating to see how the long-term players that always find themselves at the final table. They may not win, but they always find their way at the final table. That's experience and that's skill. Well, you can see those things in price action. They're like fingerprints, okay? You can see when the cannibals come in and they devour the pygmies. They go in there and just chew them all up. And it's where the market is made jagged price delivery. Always. It's always like this, folks. It's never not going to be hidden from you, okay? It's always plain sight. But see, you're so enamored by animal patterns, harmonic patterns, gimmicky named supposed retail indicators. Everybody's got a new indicator. I got one for you that's going to beat all of them. It's the open, high, low, and close, and the clock. How about that? How about that? Catch me outside. How about that? Okay. It's simple. And all of you complain, not all of you, but just the asshats do. Oh, this is complicated. This is convoluted. So-and-so teaches this so much better. Okay, I don't see so-and-so doing anything. I don't see so-and-so doing anything but using market replay and trying to convince himself everything he says after he says it. So we had these relative equal highs swept here. See that? Case study, bullish breaker, to there. So how many candles did it take to do that? You screenshot it. How many handles did it run from the low to that relative equal high being taken out? And once it does that, keep the chart active with it on there, but then just make it very, very light. Well, not that light, make it light. So that way you can still see it, but it doesn't have all of your focus. So that way it allows you to focus on, like, there's a fair value gap here. We traded down into mid gap, which is this wick here. Since price is above it, that makes it a discount array. Consequent encroachment of that trades to it. We want to see it run above this high here. But 7 o'clock is a very key time. That starts what? The morning session. It matters not that we're trading Forex or futures. The morning session, AM session, starts at 7 o'clock in the morning, New York local time. Okay, so you can have a model that says, I can't be in front of the charts between 8 o'clock and 8:30, and maybe you can't even trade the 9:30 opening bell for indices because you have to get ready for work. Okay, but it just so happens that the time elements in your personal life and geographically location in the world, that it allows you and affords you to look at the market between 7 o'clock and say 7:45. Worst case scenario, 7:30. If you're going to work with smaller time frames, you absolutely can use 7 o'clock to 7:30 as a model to do this very exercise. Same thing. So your key times are this: 7 o'clock in the morning to 7:30. In that 30-minute window, you're going to look for relative equal highs and relative equal lows that have happened prior to 7 o'clock. Okay? And you're going to be looking through the time frames of the 1-minute chart, the 5-minute chart, and the 15-minute time. Now, Caleb, you're not expected to do anything else beyond that until I change the depth of what your focus should be. Right now, you're just having 3 charts up. Since the 15-minute time frame is pretty static, you only need to refer to it once in the morning. And then your second chart could be the 5-minute chart. We'll go back. That's what it is right now, 5-minute chart. But then what you're doing is you're watching between 7 o'clock and 7:30, or 8 o'clock to 8:30, or 9 to 9:30 opening bell. You're looking for, where is the market smooth? Smooth. Because still waters invite rocks. Think about that. Remember being a kid walking and you see a pond that's real smooth. Wow, look at that. It looks like a mirror. You can see the sky's reflection off of it. So smooth. What's the first thing that jumps in your head? I need a rock. For what? Because you can't accept that. Our sinful nature says we have to disrupt that. So you pick up a rock and you want to throw it out there. Why? What's it going to do? It's going to cause ripples. That's exactly why a weak character individual in a relationship will have a beautiful relationship, a wonderful relationship, something smooth. Ain't no drama, no reason for ruckus. And what they got to do? They go out there and they chase some thought. They go to the bar, they pick up some floozy or some silver-tongued fox that says all the right things for her. And you invite that disruption. Well, that's what the market does, folks. It's a dysfunctional family environment. And you have to be the one that says, not today, Satan. Not today. Not today. I know your tricks. I know your snares. I know how you're going to do it. Okay? So, what's the market going to do? Every single session in the morning, you have 3 opportunities. And you don't have to trade in the afternoon. You don't have to trade the London session. You have 3 opportunities in the morning to set the stage for a run that will build, if you don't have any understanding about bias. When all you need is a match, this is a flamethrower. It's the thing that makes every playing field even. They cannot hide it from you. They cannot hide it from you. You're never not going to be able to see it. It's always there. And in plain terms, it's this. If you can contrast one side of the marketplace against another, let me do this. In this little area down here, okay, in this small little open section, I'm going to say this and I'm going to close it because I have somewhere to be with my wife in about 20 minutes. I hope you haven't, if you take this moment for right now. If you learned something today, and if you didn't learn something, you're a friggin' liar, okay? But if you honestly was with me this entire session and you watched me outline this and I told you why it was going to go here, what levels were key, what to focus on, and you watched it pan out and you understood and you understand now. And if you don't, I'm going to make it clear for you. But when you set up a framework of whatever you're going to study in the morning, if you're going to trade the morning session, your key times, you have to absolutely be in front of the charts between 7 o'clock and 7:30 in the morning, always New York local time. Okay? If you can be in front of the charts by 7 o'clock, this is what you're doing. But if you can't, you do the same thing at 8 o'clock to 8:30. The same thing at 9 to 9:30. Okay? This is your pre-market range. Write that down, because if you don't write it down, you're going to forget. You're going to call it the opening range. It's not the opening range. The opening range is the first 30 minutes after the opening bell. At the New York session, the first 30 minutes after 7 o'clock to 7:30, that is your pre-market range. 7:30 to 8 o'clock is your opening range. Oh, remember I was telling you I could trade every single hourly candle? Now you're starting to think. The gears are turning, aren't they? Oh, it's fun, isn't it? And obviously the 9 to 9:30, that's your pre-market range. And then post 9:30 to 10 o'clock, that's your opening range. There is no 15-minute opening range. I don't care what anybody tells you. Okay. It's a 30-minute opening range. That's algorithmic. Okay. So what you're doing, and this little range here that's being shown here with this rectangle, what I'm saying is this is essentially that 30-minute interval, whether it be 7 o'clock to 7:30 or 8 o'clock to 8:30 or 9 to 9:30, that pre-market range. In that range, what you're doing is you're looking at this line or beginning of that shaded area would delineate the 7 o'clock or the 8 o'clock or the 9 o'clock, where it begins at that specific top of the hour. And then this would be the range that makes up that first 30 minutes. Now, it's not obviously to scale, but I'm oversimplifying for the purpose of teaching what I'm saying. Prior to that range, anything before or to the left of this, you're looking for equal highs or equal lows. Which side has it? Because that's your bias. It's going to draw to that. How do you know? If you have both, because I heard you, you're thinking it. But what happens if you have a relative equal high here and a relative equal low here? Which one are you going to go for? You wait for the first one to get disrupted, because once that happens, then you work to the other one. That's your bias. So you have to defer and wait. Now, gamblers or live streamers that just want to have people watching and doing anything and not really executing on stream, but after the trade starts moving in their favor, then they'll show, oh, I took a trade here. What good is that? What good is that? That just proves you're not confident in what you're doing, and you're going to show it after it's moved in your favor. Talk about it, explain it, and then do it. I'm going to do that. But today I gave you a clinic on how to determine bias, how it's easy for me and it's easy for you. Whichever one has the relative equal highs or relative equal lows, that's a smooth area. It will be disrupted. Anywhere where you see jagged edges like this down here, see how it went jagged and then ripped higher. What's it telling you? What's it telling you? I'm going to look for buy side liquidity, buy stops. This has been a trap. They engage traders to go short. They're trapped short on a breakout, or they're not trying to take the shorts out of the market yet, and that's why you see all this in here, a little bit creeping up. This is all balanced. That's why this spike stopped right at the top of the breaker here. Isn't that interesting? Isn't that interesting? I've been talking nonstop. No chance for me to have another ad over, voiceover. It's all live. You watched me do it live. I explained the logic. And now here's the wonderful thing. You have the privilege to go back to your charts and backtest this. And your jaw is going to drop. You're going to be thinking, it's always been there. But I've been looking for this stupid ass harmonic pattern. I've been waiting for my yin and yang to appear on my chart. I've been waiting for my moving averages crossing over. But my Lux Algo indicator said this and then said that. And I got tripped up. I thought it was going to do, no, bullshit. Bullshit. It's all bullshit. There's nothing complicated about what I said in any of the mentorship videos. They're just very deep, dry lessons that give you the why. Because I'm a person that's highly technical. I want to know why it's going to do it. Don't tell me something and then do it 10 times and rewrite 10 times, and that's not going to convince me of anything. I need to know why it's doing it. And if you don't think critically about that, you're a gambler. You absolutely are a gambler. I need to understand before I put money behind it. I need to know, why is this market going to do this? Then, at that time, why should it behave that way? And folks, you can't get any plainer or simpler than just simply saying, okay, where it's smooth. Now, you're going to say, well, this isn't new, ICT. You talked about relative equal highs and lows before. Right. And I taught that you should be aiming for them. If you go back through all of this price run here, okay, what you're going to do is you're going to focus on the points that make the most obvious sense to you, that you could see and it says, you know what, I understand this. Even though ICT pointed out this breaker, you may have noticed it, maybe you didn't. If you didn't, that's not your PD array. If you noticed that it traded down into this fair value gap right there, inside of this old SIBI, which is essentially where? About midpoint between where we expect price to trade to, which is above these highs, and where it traded from. See that? So if we see where it's likely to go and where it went from, where it originated from, where's the midpoint? Well, let's do a simple measurement. Here's your fib. And we're going to say something above these relative equal highs. We'll just randomly pick an area right there. Okay. I'm just being very bland. There's no real reason I'm picking that price. It's just simply slightly above the relative equal highs. There's no other logic, simply that. Okay. So I'm not trying to complicate anything. But if you take that and you go down to the lows that are relatively equal, not the lowest low, that's the manipulation. You want to use the relative equal lows like that. Okay, you see that? And then you have essentially the midpoint here. In close proximity to that, you have this fair value gap and you have this fair value gap. And this one here can be used, even though it's a little bit above equilibrium, because we didn't take this high and that high out, which I was outlining to you real time. We didn't take that out yet. We didn't take out these two relative equal highs when it was trading down to the breaker. But what happens when it trades up here, and then at real time I said, watch this fair value gap, watch the stream. Go back and watch the stream. When we were trading right there, I said, watch, and here we are, we're trading this fair value gap here, and then takes off and runs to where we were waiting to see it deliver. The smooth areas are going to be attacked. The sharks are going to go to the still water. That's where they're going to go. Why? Because as soon as someone in there starts shaking in fear that their stop's going to be taken, that still water will ripple, and that triggers a frenzy, and the sharks are going to go right there. You don't trade into levels where the sharks have already had a frenzy, and that's down here. Okay, they've already done the work. There's been an attack down here. How do you know? There's been the great disturbance in what price was doing and how it's delivered. It's jagged like shark teeth cutting through the side of a whale's body. It's been damaged delivered. You can see it. It's physically represented in the jaggedness of the swings going down, where we don't see that jaggedness up here. It's nice and smooth, real inviting. It's safe. Put your stop loss above me, like a siren calling out to the sailors. Come to me, come to me. And he crashes them on the rocks. I know, Mr. Analogy. I don't know where it comes from. It's a gift. But you have to go through all of this price action in here and determine what price level makes sense to you.